Have you ever wondered what your balance sheet actually shows you? Today, I'm going to break it down. A balance sheet is a snapshot of a company's financial health at a specific point in time. It tells you what you own, what you owe, and the difference between the two, giving you an idea of the company's stability. At the top of your balance sheet, you will find your fixed assets. These are assets that you can expect to use in your business for a long time. The fixed assets in this example are all tangible assets. All this means is they're assets that you can physically touch, like machinery, equipment, furniture, etc. Your tangible assets are broken down into what they originally cost, any additions in this period, and any depreciation. Depreciation reduces the value of your assets over time to reflect in your accounts how their value decreases with age. After fixed assets, your current assets will be listed. These are things that the company typically owns for less than a year. First up is any cash the business owns, whether it's physical cash or money held in a bank account. Then trade debtors. This is money owed by customers for unpaid invoices. You may have come across prepayments, which represents the cost of any expenses you paid for in advance. For example, if you pay for a yearly insurance renewal 6 months into your financial year, half of that cost would be classed as a prepayment because although you've paid for the full service, you haven't received the full service yet. Another common item under current assets is work in progress or WIP. This represents the costs associated with any work completed for customers that hasn't yet been invoiced for. Moving on to current liabilities, this is any debts that the company owes that they expect to pay within a year. Firstly comes your trade creditors, which is any money owed to suppliers for unpaid invoices. Then you've got corporation tax, which is the amount of corporation tax due to HMRC at this point in time. Your director's account shows any money owed to the director from the company or vice versa. Ideally, this account should always be positive because an overdrawn director's loan account can cause complications for the company and for the director. Another key part of current liabilities is VAT. A company usually has two separate VAT accounts, a VAT control account where all the input and output tax goes, and a VAT suspense account which shows the balance due to HMRC at this time. There's also a section for provision of liabilities and charges towards the bottom end of your balance sheet. This includes deferred tax, which can be a bit complex, but in simple terms, it accounts for tax that needs to be paid in the future. The bottom section of your balance sheet focuses on capital and reserves, which essentially represents the funds invested in your business. One key figure here is retained earnings. This is the profit the company has accumulated from previous years that hasn't been taken as dividends. You'll also see the profit for the year, which is the bottom line from your profit and loss statement. Your total capital and reserves will equal the total net assets on your balance sheet. If this figure is negative, it means that your company may be insolvent, which means it owes more than it owns. And that is the balance sheet in a nutshell.